Putting it bluntly, this is not something I'm very concerned about. The first reason is size. The U.S. banking system has about 20 trillion of assets. Public First was 6 billion, so less than a tenth of 1%. In contrast, Silicon Valley Bank, First Republic, Signature Bank, those were about 400, 500 billion of assets together. So, collectively almost 100 times the size of Public First. So this is much, much smaller in comparison. Um, Secondly, I really don't view this as a harbinger or canary in the coal mine of broader problems in the system. This is, an idiosyncratic issue. There was, some specific issues related to Republic First that have been going on for quite some time. Um, as you mentioned, a group of investors had been trying to force the sale of the bank since 2001, excuse me, 2021, after they thought the CEO made some questionable decisions that were resulting in low profitability, low growth. In 2022, he was eventually forced out, and the bank's issues kept going on. Ended the year with some very low capital ratios. The stock, we don't cover it given its size, but it had been trading at a fairly low level for quite some time, leading up to the failure. And there were a number of attempts to raise equity that ultimately fell through, and hence the regulators ultimately decided to close the bank, and the deposits were transferred to a larger, healthier bank in Fulton.
In that respect, because, in so much as, and I basically alluded to the fact that this is just, one of these aberrant sets of circumstances, but it can't be ignored the fact that a lot of these banks are going to still be holding a lot of paper on their books in their HTMs that are considerably underwater. And I suppose, do you think that's ever going to come to task? Because, there seems to be this growing expectation that perhaps we shouldn't be expecting the long end to come down anytime soon. So when you think of it from that context, are you concerned about, or are there any regionals right now that you're concerned about that might be in for a little bit of a spot of bother coming up over the next, say, 12 to 18 months?
Look, I mean, ultimately, it's going to depend in large part on the yield curve, both the short end that the Fed has direct control over, and the long end that's market driven. There are some concerns for some banks from a higher for longer rate environment, both from an earnings standpoint as they're forced to spend more on funding costs. They'll have to pay more for deposits. They might see outflows of site non-interest bearing deposits, and there are some capital issues from the unrealized losses on their bond books that'll go up in a higher rate environment. These don't count in regulatory. These are not really the unrealized losses though aren't considered in regulatory capital for regional banks today. Only the very largest globally systemic banks have to incorporate that into their capital from a regulator standpoint. So, it's more of I'd say a headache for most banks than any sort of existential risk. But, it is, going to be an ongoing headwind for some banks from an earnings standpoint that people had hoped, would be starting to taper off at this point.